You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Welcome back to Mining Stock Education. I'm your host, Bill Powers. Thank you for tuning in, and I'm reporting from PDAC, the Prospectors Developers Association of Canada. It's 2020. It's the first day, and I have the opportunity to sit down with a returning guest, Warren Irwin. He's a top-performing fund manager with Rosseau Asset Management. Warren, thanks for coming on the show again today. And as we look back over the last week, there was a steep sell-off in precious metals and in the gold stocks. Based on your many decades of experience, what do you make of this?
Yeah, I just see it as being coronavirus panic related. Basically, what happens in situations like this, I've just seen it before, and this is where I categorize it, is you get a pretty sharp and unexpected sell-off, and it just triggers a bunch of margin calls, and especially in some of the juniors. There's a lot of guys, unfortunately, in the retail sector that are running on margins. So when they get some of their positions tagged for a 10 or a 20% hit, that they have to raise money to meet their margin calls, and or in some more extreme conditions, the broker that's lent them the money just basically takes over their stock portfolio and puts a market order to sell. And I definitely saw some market order to sell orders over the past week. So there are people panicking or in distress situation where there actually are forced sellers at some of these pretty low prices.
Would you agree with those that say it can't be compared to the sell-off of 2008, at least as it regards to the junior miners, because the junior miners are still so depressed?
Yeah, it's funny because when we talked last fall, things were super duper cheap then, and it just never seems to end. They get cheaper and cheaper and cheaper. And I was talking to you earlier about the one example I gave. I bought NextGen from a distressed seller about 5 or 6 years ago for 60 cents a share before the discovery was made. NextGen went on to find the biggest and richest uranium deposit in the world, hard rock, so it's not heavy-duty capex like some of these other mines. It's an amazing deposit, and it's now backed financially by Li Ka-shing out of Hong Kong. And despite all those positive developments, a big discovery, it's in Saskatchewan, great management team, they've got cash, everything's going fantastic on the permitting side. The stock is not even a double from before the discovery. And when I bought, I could assure you, I got the cheapest prices I possibly could at the time, and I bought a significant portion of it from a distressed seller. That shows you really how bad things are out there.
So the best opportunities are in those developers with resources that are cashed up and then are sold off?
Yeah, well, you and I could talk about this a little bit, but I see this usually. These are telltale signs of the bottom of the market. Is when people ask me around the PDAC today, would I lend them money to go and find this gold deposit or that base metal deposit or whatever? And I go, no, I'm not giving you any money. And they say, why? And I say, well, because I could buy companies that have already made the discovery, already been drilled out to a fairly good degree for super duper cheap prices. And I said, until I get paid for those through either a corporate takeout or just movement in market price, I'm not about to invest in junior explorers right now. And when we will see the turn is when some of these cashed up majors say, okay, well, we really like your uranium deposit, your copper deposit, your coal deposit, or whatever, and they pick you off, and you get a nice big fat multiple, and then you could roll that into something else. It's just kind of like perhaps what's going on right now with Continental Gold. I imagine a lot of the shareholders who sold their Continental shares are sitting on a bit of cash, and they're going, well, where should I start redeploying it? And that's a position I'd like to be in at some point this year, where I've sold one or two of my majors that have made these big discoveries at decent to fair prices. Then I'm willing to do the next step, which is start funding exploration again. But I think exploration will be pretty tough to raise money for until we start rewarding guys like myself and investors like myself who've paid for exploration in the past. We've made a nice big discovery. It's tremendous. And get paid for it, and we are not getting paid for it. So there's no incentive for me to find more because we're not getting paid for it. So
in our first interview a few PDACs ago, when you shared your story about the BRIEX scam, I remember that you told me that was a direct result of the cash from Voisey's Bay that was redeployed into Bay Street, that there was a lot of money sloshing around. So with yourself and other investors like yourself that will get the payout and a buyout, that you would be willing to reinvest in the juniors, do you think that's the key catalyst to move this sector higher? Because obviously gold's been up $350 and it definitely didn't lift the whole sector.
Yeah, no, the market compared to the 1990s, right, where we're looking back, that's 25 years ago, right? That's the mid 90s. There's a lot of things that have changed, and a lot of people, when they invest in, let's say, the gold sector, they won't invest in individual companies. They'll invest in the ETFs. So they don't have to worry about any company-specific risk, and I don't fault them for that. But as I see happening, generally what I see in the resource market is, in my experience, you really need to watch the funds flow, right? So why would anybody buy gold stocks, for instance, or any resource stocks? Well, they buy into them because they're concerned that their peers are making lots of money in the sector, so they can't be left behind from a performance standpoint, so they need to jump in and buy some. And that's when things kind of get stupid. And they'll buy initially the majors or the major gold companies or the ETFs. But if that continues, and once the ETFs get quite expensive and the majors are expensive, it's only then really that people will start looking at some individual stocks, more speculative, that requires them to do a ton more legwork, a ton more work than just buying a plain ETF, which requires zero work really from a due diligence point of view. And it's really at that point that people go to that level. And I used to joke with people and say, well, when do you know there's a top of the gold market or the junior resource market? And I say, well, I know it's the top of the market where you're getting pitched private junior resource deals, meaning that they want the cash today, but they haven't got the time to go through, grab a shell or file a prospectus and go through that whole process, and they just need the cash today and they want to capitalize on it. That's usually the very, very end of the cycle, because that's arguably the dumbest money to put to work is in a private junior at the late stage of a cycle. So you're paying the big multiples, and you're not, buying a junior private at the beginning of the cycle when you're paying a couple pennies versus near the end of the cycle after the majors have run, the ETF stocks have run, the ETF juniors have run, then all the other non-ETF junior have run, and then now they're going, the last batch of stocks that haven't run would be the privates, and that's usually an indication that the market's getting pretty tired.
In your fund, you focus on the high risk, high reward, but as you analyze, if you do analyze the royalty companies, that's another place that investors that don't focus a lot of attention and due diligence on this sector, they go to GDX, GDXJ, and the royalty companies. Do you consider the royalty companies overvalued right now?
Yeah, no, it's interesting. I don't spend any time whatsoever even thinking about the royalty companies because it's just not my thing. So I really don't have a strong view on that. They have been, a number of them have been good winners for investors, and obviously they like that. The only thing I see going on right now is there seems to be a new royalty company every week, and they're trying to put royalties on everything, and each one has their own little different story. And you got to think the market's going to get pretty saturated after a while, and if they're all chasing the same deals, you have to think that at some point returns aren't going to be there with that level of competition.
Do you think that part of the depressed nature of the junior sector could be from shorting, where funds and other entities are coming in here and putting the downward pressure on the sector through shorting?
Yeah, you hear that from time to time, but I just go, okay, well, try and get a borrow on half the names out there. It's really tough. There's so many restrictions on what stocks can be shorted, which ones you can get borrow on. And like I deal with BMO, one of the biggest banks in Canada, and I would think 90% of the time I call them up and say, I'd like to short this stock, and they go, well, it's below X number of dollars, so we can't short it. There's this or that, and there's 1,000 different reasons that you can't get the borrow. And if you can get the borrow, then you can't short the stock because of various other technical factors. It's quite difficult to short. And in my experience, shorting something like the golds across the board, being unhedged on the other side is pretty dopey because, as you can see, gold could be volatile. It could be up a couple $100, and you could be wearing that pretty hard, and trying to do an emergency cover on a thinly traded junior gold stock, it's pretty nutty. But if there's guys out there perhaps long the ETF, short a number of the ETF components, I could see that. I could see them if they're hedging with a short. But as far as an outright naked short of the junior gold sector, boy, those guys would have a lot of guts, because more guts than I would have, because we could wake up tomorrow and something could happen and these stocks would be up considerably, and then try and cover that short. It would be really a disaster for whoever did that.
We'll be right back after this word from our sponsor. Trilogy Metals is a world-class developer in Alaska's Ambler mining district. The company already possesses 8 billion pounds of high-grade copper, 3 billion pounds of zinc, over 1 million gold equivalent ounces, and over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion, with a 33% internal rate of return. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades in New York and Toronto under the ticker TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com. When we spoke at Beaver Creek, an exploration company that you were excited about and have a position is Cantex, and that shot up like a rocket. It was up there, I think, $4 or $5 when we spoke, and it's come back down to earth like a meteorite. What's your thoughts here, and how have you played that?
Yeah, one comment I may have mentioned in the interview. Did I mention this? Unless Mother Nature is going to be a total bitch. Oh. So Mother Nature has been a total bitch. And the deposit has not been at all as consistent as I had hoped, or some of the other investors, and it's been quite spotty. I think as far as management goes, I could definitely fault them in some of their drilling strategies. I wasn't pleased with how they blew a ton of money in what they did with respect to the drill holes. They drill they drill 2 holes from a pad, and they get no results, and then somehow drilling another 2 drill holes in between those 2 drill holes, what are the odds of getting something? You know what I mean? So I'm faulting them for that. I think they wasted a lot of money going too late in the season without the good results to justify going too late in the season. I also think they drilled too many holes from from the same pad without getting the results they're getting. But you see they got a really good new board member that I know on board, and they've got a bunch of money. They've got another drill season ahead of them. Next year will be very, very important for them to kind of prove that we didn't waste our money by backing these people. And they've got some good results, but they're quite spotty. There isn't a level of consistency that I had hoped there would be. And also, I think the stock got way ahead of itself. I think it almost got to $7 at one point. It was through to $6 anyways. And the problem with that is sometimes you get people too excited, and it's just too thin of a stock. It's really it really can move on you. But they have one more drilling season. I think they've learned a lot. I think over the winter here they're getting a lot of people helping them from the structural geology side, where they definitely need a lot of help. I think with the structural geology work, and with some real smart work on the future drill program, they should have a decent shot here next summer of perhaps getting some good results and trying to zero in on where the ore is, if there is an ore body. So yeah, it's a huge disappointment for me, and we'll see what happens next year.
And the project still has the size potential that you talked about earlier?
You never know. It has... The people I know that are sharper than me with respect to geology basically believe that is the case, and we'll see what happens.
Now, in that case, you backed the CEO because he made you money in the past?
No, he lost me money in the past.
Lost you money in the past?
Yeah, he lost me money in the past. It was more like, despite having lost $2 million with Chuck about 15 years ago, I said, I'm going to give Chuck another chance, and then I lost so much more money. So,
but he had a good discovery in his resume previously,
yeah,
right?
He's obviously the founder of the Canadian diamond business. He's a billionaire, and he found the Acadie diamond mine using the same, determination and smarts that he has. He's a very smart geo, very determined. This is the kind of guy who makes discoveries. He's really wacky, but he's focused on this, and he's in the market buying back shares at these levels. So he's obviously of the belief it's not dead yet. So results will speak next year. We'll see what happens.
As you look at your portfolio, what stock gets you most excited? What's the most perspective in terms of future gains?
Future gains, yeah. Well, there's various levels of risk. For instance, that's an interesting one because it's all risk reward, right? So the highest risk I have in my portfolio is one which has not been drilled yet, right? Whereas, let's take a look at two names. I'll take a look at one that has not been drilled, but I think we have a heck of a shot. Okay, that's probably the highest risk. That is GPM Metals. It's basically we've optioned a property off of Rio Tinto. So Rio Tinto is our partner, and we'll be drilling an undrilled Gossan that hasn't been drilled since Rio Tinto got kicked off the site 50 years ago. It's been a legend within Rio Tinto. If you speak with a lot of former Rio Tinto executives, they'll say the Walker Gossan has mythical proportions inside Rio Tinto. Well, we managed to cut a deal with Rio Tinto. It took us 2 years. Spent 2 years cutting a deal with the indigenous people of Australia, and then we drilled one of the prospects in which we had ability to drill, and it indicated to us that the zinc ore body was drifting towards the west, which was onto a property we had the rights to, but we didn't have the permission to drill. So we're working on that right now. So hopefully within the next year or so, we'll have access to drill it. But it's right on strike with MacArthur River Mine, Mount Isa, Century, Lady Loretta, all these massive zinc deposits, right on trend. It's the largest undrilled Gossan in the region, and a lot of really, really smart people think we have one heck of a shot at finding a major world-class zinc discovery. So that's the high risk. For people who maybe aren't quite as high risk, there is an interesting one I'm involved in British Columbia. It's called Colonial Coal. They already have 700 million tons of high-grade metallurgical coal drilled up. Metallurgical coal trades in the 150, 160 range. You could buy that in the ground, drilled up in Canada with a good management team that's done this before, built the companies, sold companies, for a nickel per ton in the ground. That is extraordinarily cheap. Comparable transactions have happened in British Columbia, in southeastern British Columbia, with similar quality metallurgical coals in the neighborhood of $2.50 to $3. So, needless to say, there's somewhere in between 5 cents per ton and $2.50 a ton is the value of colonial coal, but it's definitely not 5 cents. I ran into this once in 08 when I owned a small stake in a heavy oil company, and we were capitalized at 1 nickel per barrel of bitumen in the ground. When the market turned around, within 9 months, the stock had gone from $2 to $17, and they'd already paid and they just paid a $4 dividend. So basically $2 to $22 within 9 months. Colonial Coal has the potential for a multi-bagger, and they've already got the ore body, so there's no question about that. They're in British Columbia, good management team, good relationship with First Nations. So it has a multi-bagger potential without that discovery risk. There are other risks, as you know, with any of these mining companies. You can never say anything's risk-free. There's always something that rears its ugly head at some point that could screw you up.
Would you articulate that your investment in NextGen or Colonial Coal, it's essentially a high-quality optionality play on the underlying commodity? Would that be accurate?
Well, you know, Colonial Coal, I don't care if the price of metallurgical coal trades higher. What matters there is that there's a major steel company or coal company that wants to get vertically integrated and needs high-quality coal, and the bidding will start, and we'll see where the bidding ends. But I think it'll get much closer to what the fair value is by the end of that. With respect to NextGen, I think there's only two logical buyers of NextGen. initially anyways, the economics are so strong, it's almost compelling enough if you're even not in the uranium business to go into the uranium business if you are a mining company. So, but I'm thinking the most logical buyers of NextGen are Rio Tinto and Cameco. The issue with that and how do we get paid for that is, Li Ka-shing's in around $3. The stock's trading at $1.19. So, the possible acquirers aren't going to be paying $5 a share anytime soon. So we kind of need to get a little bit of wind at our back with respect to the uranium price. Get, Cameco feeling good with their stock moving higher. Get Rio Tinto feeling better about the uranium market, so that our stock also starts running too. So when our stock's at $3.50 a share, let's say, people are more willing to pay $5.50 or $6 or whatever the number is, the final takeout. But here, when we're down and out at $1.19, I would think that if Cameco came for a bid at $2.50, which is a double, I think Li Ka-shing would tell them to get stuffed, right? So we need to get a little bit of wind at our back, I think, in the uranium market, get a little bit more robust, get the market cap up a bit, and then we'll see what happens.
When you invest, do you pay attention at all to the gold-silver ratio or the platinum-palladium ratio?
No, I don't. I just, it's not my thing. I'm not a super big fan of silver. It's tricky to trade. It's tricky to kind of understand stocks that have that are really a significant amount of it is byproduct production. That's really, really tricky. Whereas gold has a fair amount of primary production. Where byproducts, silver will be produced no matter what, so long as the underlying commodity that's being produced is profitable. They'll produce as much silver as comes out of the mine, and they don't care what the price is, and they'll sell it into the market. Whereas with gold, giving the majority is primary production of gold, if gold drops in value, the mine shuts down, right? Whereas that's not the case with silver. They just keep producing no matter what the price deck looks like.
Lithium equities have been going up at the end of last year and in first couple months of this year. Do they attract your attention at all?
Yeah, I'm not a super big fan of lithium. The reason I see it is we all know there's no shortage of lithium in the world. And when you look at lithium around the world, whether it be hard rock or the salars in Chile and Argentina, there's lots of it. And if you take a look at, I haven't done it in detail, but my friends in the lithium business tell me that Bolivia has a massive resources of lithium. The only issue is they have quite a few nasties in them, nasties meaning metals or elements that you can't get out or hurt your end product. I believe if lithium does indeed end up being the basis for the future battery technology in cars, they will crack that nut and they will find a processing mechanism in which they could take those nasties out, and then that opens up a massive new supply of lithium. So there's massive supplies on the horizon. So any long-term move in the price of lithium higher will just accelerate all that new technology that'll go towards dealing with purification of the lithium that's currently out there, and there's lots of it.
A lot of people are talking about the trends in ESG, environmental, social, and government. What are your thoughts here? Is it significant? Yeah,
it's sort of the ultimate in political correctness, millennial, vegan, environment. It has everything so politically correct, it's unbelievable. When I was down at the BMO conference last week, nobody could shut up about ESG, and it wasn't that many months ago I didn't even know what ESG meant. So, and I'm in the mining business, so okay, ESG, you're talking about the stuff that we normally do anyways. So it's so obvious and common sense to me that ESG is an important part of any successful mining company. To zero in on it the way they've been zeroing in on it recently, it just seems to be flavor of the day, political correctness, and it's driving me nuts, the political correctness of we're going to be carbon neutral on this mining development side, and the mining development site. Okay, great, but you're burning tons of coal on 10 of your other projects. You're making one little poster child for solar and wind energy, and great, but take a look at your entire overall footprint. It just drives me crazy what's going on here. And while I'm on this topic, I just get a kick out of the mining protesters that are protesting mining. I guess these people don't understand where the copper for these new electric cars comes from, or the lithium, or any of the materials that they use in their everyday life. They mustn't understand any supply chain whatsoever. So it drives me absolutely nuts to see these protesters protesting everything under the sun, and it's crazy. Yeah.
Warren, as we kind of wrap it up here, for the investors that are listening to us, what would be your final advice for 2020 for mining stock investors?
Yeah, well, my thought would be there's some tremendous high-quality assets out there that have already been found. They've already been drilled out, and they're super-duper cheap. And why spend money looking for more of it if you're not getting paid for it when you do find it? So there are some tremendous stories out there that are a little less on the risk scale because they've already found it. And those will be, in my opinion, those will move before the exploration stocks will move, because again, you have to prove to guys like me that we'll get paid when we do find it before we'll spend money again to find some more. So we've got names like Colonial Coal, and the other one too I'm involved with is Cornerstone and NextGen. These names are super cheap. They've already have their deposits already significantly drilled out, and they're there to be had super cheap at the bottom of a cycle. And if you have some patience, they're good names to own.
Excellent. You've been listening to Warren Irwin. He's a top-performing fund manager with Rosseau Asset Management. Warren, thanks for joining me today. I really appreciate it.
Always great chatting with you, Bill. Cheers.